Hi, my name's Chris Whetstone from Flambard Williams, and we're going to run through, like we do every month, the latest Zoopla report that comes out at the beginning of each month. Now, we do everything in this report from the latest house prices, what's happening with mortgage rates, supply, demand issues, and of course where we think the market's going to go. But don't forget, we are going to run through this from an investment perspective. We're not looking from a residential side of things. This is purely from an investment perspective. So if you want to hear these videos constantly or be updated, hit the subscribe button, and these will be in your inbox each month. So look, without further ado, let's take a look at the report. So the first thing is, you can see here that the current year-on-year market is dipped 0.5%. Nothing major. Now, the reason why we want to bring this to people's attention is because every time we have a little blip or some issues in the market, which happens from time to time, you have all the so-called experts saying it's going to drop 10, 15, 20, 25%, etc. But the reality is that very rarely happens. 2008 was a telling time when we had one of the worst crises in history since the 1920s, and that only dropped between 15 to 18%, depending on what institution you ask. But the reality is right at the mini budget, everyone was saying back in the last September, we had experts saying that it's going to drop, as I said, over 20%. It hasn't happened, and we actually are on track to only fall between 2 to 3% this year, max. But importantly as well, you can see here the rebound in demand. Now, it is coming off of lows, so that sometimes masks a certain figure, but the reality is that demand in September has bounced back up, and you can see the discount for the asking price is 4.2%, so that's not a major thing. We saw discounts in years gone by, 2008-9, when it was 15, 20% below. But now you're seeing, as I say, only 4.2%. A lot of people are actually holding firm. People have still got money in their pockets. That's proven by stubborn inflation. And the mortgage rates, in this report, it says they're expected to come down below 5%. But we know this week that's actually already happened. So if we look at like the executive summary here, what you can see as we mentioned, house prices negative, ranging from 1.6 in Scotland to 1.5% in the southeast and eastern regions. There are some regions that are still going up, which we're going to come to at the end of the video. Demand is up, as we mentioned there, by 12%. Buyers unwilling. Now, this is interesting as well. Years gone by, if you couldn't afford something, you had to adapt. You had to maybe get a smaller property or a smaller garden. But buyers are unwilling to compromise. They're saying, no, that's what I want. I'm willing to wait. And I'll either wait for house price falls, or I'll wait for lower mortgage rates, or a bit of the two. Then, of course, we come on to what the mortgage rates are expected to do. They are expected to fall. We might even see mortgage rates back down to the 4% mark by the end of the year, which will be phenomenal for the market, and that should buoy the market in 2024. The number of buyers, of course, is going to increase once we start to see those mortgage rates below the 4.5% mark. And again, the cash buyers are still in line with 2022, while the mortgage-backed sales are likely to be 28% lower as rates impact demand. But the key to that is the cash buyer sales is still there. We know from being inside the market here, right at the coalface, so to speak, is that in terms of cash buyers, we are seeing more and more cash buyers, especially from overseas, taking advantage of the weak pound at the moment. So it's a really buoyant market from an investment perspective. But of course, it still remains a buyer's market. There's still discounts to be had. And I'll be honest, if you use the right agent, you can get better discounts than that. So look, let's have a look at what the market is doing. The market activity is tracking close to 2019 levels. Now that's interesting because many people are saying, oh, we've had a big dip, it's going to crash, etc. The problem is they're comparing it to 2021 and 2022 when we had an abnormal market. It was abnormally buoyant, abnormally high, and prices increased beyond where we expected them to. Many predicted a 3 to 4% gain. They went up 10 to 15% in some areas. So we know that that was an abnormal market. We cannot compare to those years. They were an anomaly. We've got to go back to a normal year, 2017, 18, 19, and we are tracking close to 2019 levels, which is key. Importantly as well, you've got, as I said, demand is increasing. People are starting to realise that the higher rates, the high mortgage rates that were once here, the 6, 7%, have now fallen away. Maybe time to strike while the iron's hot. And of course, importantly, that's why we've seen a 12% increase. But of course, it has come off of a lower base. In fact, if you look at this chart here, what you can see is it's really quite interesting, where you can see the peaks and trough of the demand. You can see where we had sort of stamp duty holiday just here. Again, the market goes extremely buoyant. You can see if we head back towards March 2020, the start of COVID, it absolutely plummeted. But the reality is we head back towards March 2019 and September 2019, you can see here that this dotted line that's going through, and we're pretty much at the same level. So we're not abnormal in terms of where the demand is, but it feels abnormal because the demand has been unbelievably high post-COVID, immediately after COVID, and then the stamp duty holiday, and then again roughly around about February, March 2022 as well. And of course the mini budget hit, and that really derailed, and we come back towards where it was in COVID times. But again, we're pretty much level where we should be. The buyer demand as well over the last 4 weeks to the 5-year average is 31% down. That's why we're coming off a low base. But again, we're going to start to see that increase towards the end of the year as well. But this is really interesting. Buyers unwilling to compromise. Times gone by, as I say, you go back to certain markets in the 90s where the market was really buoyant, and the early 2000s. People had to compromise, they had to adapt, they had to change, they had to get smaller properties, smaller gardens, and they had to really change what they were open to doing. Some people that had kids, well, they had to put 2 children in one room if they couldn't get enough bedrooms, but it's changed. People are more demanding on what they want, and because of that, that's really created a nice foundation on the property market and the property prices. And you can see that mortgage rates remain over 5%. They don't actually as of this week, but at the time of writing they did. And reduced buying power by 20%, but buyers are still saying no. They know what they want, and they're going to either wait until house prices fall, or they're going to simply wait until mortgage rates come down. Now you've got, in terms of the actual buyers, house prices at the end of 2023 compared to pre-pandemic levels in Q2 21. This is more to do with the demand side of things. But again, you've got regional changes. We're going to come to that more towards the end. But this is key. The price falls here are modest, on track to be 3% lower than 2023. That's not that much at all, over 2023 I should say. We're not talking about those big house price falls that people predicted. The Bank of England were again, COVID time, or Brexit, they were saying 30%. COVID times 30%, and now they were saying 30%. And they haven't happened. You've got a big institution making erratic predictions, and they've fallen 3% on average. But that's on average. If we actually scroll down to the areas that we're dealing with, and especially the investment areas, take a look at the top 9 there. You've got Edinburgh, Glasgow, Newcastle, Birmingham, Nottingham, Leeds, Liverpool, Manchester, Sheffield. They are still either flat or increasing, 1.7% in the case of Edinburgh. It's the case of a lot of the other areas, either sub areas or the major city centres, such as you've got Cambridge and Oxford, chunky in those areas. London, of course, 1.4% down there. So if you look at the map, it's key. You can draw a line through it pretty much, and you've got all the south here, which is falling, and whether it's southeast or southwest, and you've got the north, which is still clinging on and actually making some good inroads. For the last decade, we've been saying buy in the north, and it's been proven to be correct. The reality is that the south, the affordability in the south has been hit far more than the affordability in the north. We then come on to the rental market. Now, the reality is that the rental market is unbelievably strong. So if we can go and get discounts, which you can see here, discounts are there to achieve a sale. It's saying on average it's just over 4%. I can assure you that we're getting discounts of over 10% to some of our clients, especially on some of the Liverpool, Manchester, Sheffield and Leeds inventory that we have. Phenomenal discounts. That means that the kind of yields that we're making, whereas before in terms of your rent meant your income was roughly 4 to 4.5%, we've now got properties out there that are giving you an 8% income yield on a normal traditional let, because we're getting the prices far cheaper than we were a year ago, but also the rents have increased dramatically. So combine those two together and it actually makes for such a good investment. So it's a great time to get on board if you're looking for an investment. And again, the outlook is pretty straightforward. It's going to continue to adjust to higher borrowing costs. You've got mortgage rates more than doubling, but we do expect them to come back down over the next sort of 6 to 12 months or so. We expect them to slowly decrease the mortgage rates towards the end of the year, but we expect 2024 to be a really good year for mortgage rates coming back to a bit more of a normal level, and of course making it even more lucrative from the investment perspective. So overall, there's still opportunities. Great time to buy an investment because you're getting at a discount with higher rent than you would have done 1, 2, 3 years ago. So any questions, guys, feel free to email in, give us a call, and I look forward to seeing you soon. Take care. Bye-bye.